Hello everyone, and welcome to this portfolio construction webinar brought to you by Netwealth. My name is Liam and I'm part of the Netwealth marketing team, and I'm delighted to be joined today by our very own Nigel Smith, who is part of Netwealth's technical services team. Nigel will be providing you with an overview of all things new with super contributions since last tax time to help you get the most out of June 30 and beyond for your super savings. But before we get stuck into all of that, I'll just quickly run through some housekeeping items. This webinar is being recorded and you will be sent a copy of the slides, the recording, within a week of the conclusion of this webinar today. And if you would like to share anything on the social world about today's presentation, please include hashtag NetwealthInvest or @NetwealthInvest. Now, while we usually do a question and answer section at the end of our webinars, today we will not be answering any audience questions. Given the nature of this webinar, we unfortunately cannot run the risk of anything being taken as personal advice. So we apologize for this, but hope you do understand. However, at the end of Nigel's presentation, I will share some contact details for you to send any pressing questions to. Speaking of personal advice, as always, the information presented today is general advice only and is not intended to be a substitute for personal financial advice, and it has not taken into account your personal circumstances. Now, introducing today's speaker, as mentioned before, we are delighted to have one of our in-house technical services experts, Nigel Smith, with us today. Nigel has been with Netwealth for over 12 years and has been with the technical services team for the last 9 years, where he works alongside our other resident expert, Keith Chu. He is responsible for the provision of technical and strategic advice to fund trustees, planners, accountants, and other Netwealth clients, covering areas as diverse as tax, superannuation, contribution management, pension planning, Centrelink, and estate planning. But today he is focusing on super contributions. So Nigel, I will let you take her away.
Terrific, thanks Liam. Thanks for the introduction and welcome all. Just get this technology working correctly. There we go. We've got the agenda up there for today. I believe we're going for around about the 40-45 minutes or something along those lines. So hopefully we'll give you some good insights and some good tips for super and coming up to 30 June. As Liam said, we are going to be concentrating primarily on contributions to super. Obviously, there were an awful lot of changes that happened over as at 30 June 2017, that covered an awful lot of things other than just contributions. But given the time of year, we're just going to be concentrating on contributions. So as you can see from the agenda, we've got a fair bit to get through. Essentially, I've tried to divide it up into 5 sections. The first section really is sort of the general concepts and that are key to understanding contributions, revolving around your total super balance and transfer balance accounts. We often find a lot of confusion with those two concepts. Then we'll be looking at the changes and the new rules that apply to contributions, specifically the main contributions anyway, being concessional, personal, non-concessional spouse and super co-contributions. Then we'll have next section, we'll have a look at 3 of the most common problems which we face. And by common problems, I mean, we get these questions every year, and I reckon I've been getting them every year probably for the last 9 years that I've been in tech services. They are really, really common issues that just arise every single year. They are not difficult to combat. They are impossible, sometimes impossible to resolve. So essentially, when we're talking about these ones, it's going to be, for God's sake, get it right first time, because trying to solve the problems afterwards is just way too difficult. Then we'll have a look at some future opportunities which are not necessarily available in this financial year. So we'll be looking at the carry forward of unused concessional contributions and the new downsize of contributions, which we're getting quite a few questions. And then, time permitting, the last section is just going to be a bit of a 30 June reminder for self-managed super funds. Won't relate really to contributions, but I thought it was important just to cover a couple of issues there which are fairly topical for self-managed super funds. Hopefully we'll have time to get through all of that. As Liam said, we can't really handle questions, but by all means, please email them through and we'll do our best to help you. So let's start with the total super balance versus the transfer balance cap. These are both set at 1.6 million. They both began from 1 July 2017, but they are really very, very different concepts. And it is critically important to understand where they fit into the overall superannuation landscape so that you know how it impacts particularly on contributions. So generally, your total super balance is, as I say, set at 1.6 million, and generally is calculated as at 30 June of each financial year, and it applies for the next financial year. So you set it at 30 June, and it makes it is then taken into account when you're calculating super contributions in the next financial year. There are very rare instances where you might calculate it mid-year, but again, nothing really to do with contributions. So we'll keep moving on that one. And what the total super balance does is it values your total super interests as at that particular date, or as at 30 June in this case. Super interests is probably another concept that you're not particularly familiar with. Essentially, super interests are represented by each of your member accounts. But from the ATO's perspective, they draw a distinction between accumulation accounts and pension accounts. So more particularly in a self-managed super fund, we often see where members have a number of accumulation accounts. For example, they might have one accumulation account which their employer is contributing to, SG and things like that are going into, and they might have another accumulation account where they're putting their own personal non-concessional contributions into, and they'd like to keep those two separate so they can view what's going on, easy to track for record keeping purposes and all that sort of stuff. From the ATO's point of view in a self-managed super fund, it doesn't matter how many accumulation accounts you have, that forms just a single super interest. You could have 15 of them, and it is still just a single super interest. But if you have a pension account, then each pension account is a separate super interest in a self-managed super fund. So again, you may have 2 or 3 pension accounts. Each one of those is a separate super interest. So what we're doing with the total super balance is making sure that we have all of those various accounts captured so that the ATO knows what your total balances in super are. And what the total super balance equals is the accumulation accounts. And in this case, accumulation accounts includes transition to retirement pensions or TRISs, which are not in retirement phase. And again, that's just another whole can of worms if we want to go down TRISs and things like that. But it equals your accumulation accounts plus your TRISs, which are not in retirement phase, plus pension accounts that are in retirement phase, your account-based pensions, things like that, plus any rollovers which are in transit. TSB, the transfer, your total super balance, becomes very relevant when we're working out your eligibility for going forward, the unused concessional contribution cap carry forward, which we'll talk about in some detail later, non-concessional contributions caps, and the new revamped bring forward rules, government co-contribution, spout contributions tax offset, and there are certain implications as well for self-managed super funds in terms of asset segregation. The transfer balance cap, on the other hand, is also set at 1.6 million, and it's the total limit that can be transferred to tax-free retirement phase pensions. Essentially what we're talking about there is the total that you can have where you are not paying tax on the earnings of the fund. But it has no impact on the eligibility to make contributions to super. And this is where we see an awful lot of confusion happening because they're both set at 1.6 million. So an example of where the confusion arises would be, for example, if a member has 1.6 million in pension and $400,000 in accumulation. In other words, the scenario is they probably had $2 million as at 1 July 2017, and they had to transfer 400,000 back into accumulation and keep 1.6 million in pension. Can they make a $25,000 concessional contribution to superannuation? This is the sort of question that we get quite a lot. The general answer that most people come up with is that they often think that they cannot because they're already over the 1.6 million TBC, and therefore they can't have any more in super. But the issue here is that the TBC, your transfer balance cap up there, as we've said, has nothing to do with contributions, has nothing to do with concessional contributions. Yes, we are above 1.6 million for the total super balance. But that affects non-concessional contributions, not concessional contributions. If we have a look on the left-hand side there, we'll see that it's only relevant for working out those particular issues, not concessional contributions. So in this particular scenario, yes, you can still make your $25,000 concessional contribution, but you could not make any non-concessional contributions. So this is where these two concepts become very, very important, and we'll refer to total super balance most of the way through the presentation. Occasionally we'll have to talk about the transfer balance cap, but try and remember these particular concepts as we're moving forward. Okay, so let's look at concessional contributions, which are things such as your salary sacrifice, personal deductible contributions. They are essentially contributions which are coming from pre-tax income or are personal deductible contributions. So the new rule from 1 July 2017 is that the concessional contributions cap is now set at $25,000 regardless of your age. Previously, it was set at 30 or 35, depending on your age. So there's a bit of complexity that has been taken out of the system there, but probably a bit of the advantage as well because the cap has been reduced to 25,000. So that's the maximum amount that you can put into super in a single year and gain a tax deduction for. What is unchanged is the fact that it is still taxed at 15% by the fund at the point of entry. So there's been no increase in the rate of tax, just decreasing the amount you can put in. What is also unchanged is that you need to complete a Section 290-170 form, which is the notice of intent to claim a deduction for a superannuation contribution. And you will hear me talking about the 290-170 quite a lot because it's a very important election which needs to be made. While we hadn't mentioned on this slide, it occurred to me as well that it's probably worth mentioning what's called Division 293 tax, which is essentially the additional 15% tax payable by high income earners. Where the salary cap for Division 293 has been reduced from 300,000 down to 250,000. So essentially what this means is that where your salary plus your concessional contributions are in excess of 250,000, then you're going to pay the additional 15% tax on the super contribution, just on the contribution, not on the earnings, at the point of entry. And then you pay, as I say, the additional 15% contributions tax. So in an example of where you have a salary of $250,000 and $25,000 in concessional contributions on top of that, total $275,000, then you're going to end up paying 30% tax on the $25,000 going into super. On the other hand, if you had a salary of $240,000 and $25,000 on top of that going into concessional superannuation for a total of $265,000, then what's going to happen is that you're going to pay the normal 15% tax on the 10,000 of it, and the additional 15 for a total of 30 on the last $15,000, which is above that 250 limit. So again, these are things to bear in mind. The key points here, looking forward at your concessional contributions, is to check any salary packaging or existing contribution arrangements against the $25,000 cap, so as to avoid any breaching. Often we find that these arrangements are put in place and are simply continued from year to year. Brief example of that might be where you have an arrangement with your employer that you're going to put any bonus amount into superannuation as a salary sacrifice arrangement. If you were planning on being able to get up to $35,000 in that, then you're going to find yourself with a $10,000 excess. So again, you need to review any existing situations. Even though we've only got a month to do it, you need to review that to make sure that you avoid the possibility of a breach. If we're making personal deductible contributions, we must complete notice of intent, the 290-170 form, and receive acknowledgement before the deduction is valid. That happens fairly automatically when you're in a retail fund such as at Netwealth. So if you do elect to make that a deductible contribution, then you will automatically get that acknowledgement back from the trustee. It's not necessarily quite so automatic in a self-managed super fund where either the accountant or yourself has to take responsibility to get that out. But to make the deduction valid, both elements must be completed, the election and the acknowledgement. Not many people realise it, but the default position on any contribution going on into super is that it is a non-concessional contribution, and therefore it does not get the tax deduction until that 290-170 form is put in. So the mere fact that you put that contribution in, maybe back in December or January, and yes, I fully intend to make that deductible, unless you remember to put in that 290-170, you're not going to get the deduction. So it's very, very important that you put that notice in. And that notice must be given prior to certain events happening. We'll touch on those a little bit later, because they form one of the three common problems that we always come across. And of course, the last point there is that you can only deduct up to the available assessable income. I know that probably sounds obvious to many of you, but you'd be surprised how often we find people contributing $25,000 to super, putting in the notice to get the deduction, and then finding they've only got $10,000 or $15,000 worth of actual taxable income by the time that gets around to 30 June, and you get a bit of a mismatch there. So again, something to watch on that one. Personal contributions, which are amounts contributed to super from after-tax income, that is, from your take-home pay. There's been quite a change in there, and there's actually a very, very powerful change to take advantage of, and that is the new rule is from 1 July 2017. Most people, regardless of any employment arrangement, can claim a full tax deduction for personal super contributions up until turning 75. I would note there that from turning age 65, that is above 64, onwards to 75, you must meet the work test. So it's not quite as good as we hoped it would be, but it's much better than the old rule, which was that personal contributions were only deductible if 10% or less of your income was from an employment arrangement. While that sounds complex, the easiest way to look at that is imagine a doctor who's earning, say, $50,000 from attending at a hospital, being a doctor in a hospital, and he has private practice and he's earning $200,000 from his private practice. Then because the $50,000 is more than 10% of his overall income, he was not able to deduct personal contributions. From 1 July, he can, because now it becomes deductible and the full deduction is available despite any employment arrangement. So that becomes a very, very powerful tool. As I say, it's not perfect. From age 65 onwards, the work test must still be met. And the work test, of course, is that you must be gainfully employed for at least 40 hours over 30 consecutive days during the financial year. And the test must be met prior to making any contributions. So again, it can be a little bit difficult to be able to meet that particular test by, say, the 2nd of July or something along those lines, because you've got to meet the 40 hours. If claiming the deduction, the personal deduction, the $25,000 concessional contribution cap still applies to total contributions. So again, you've got to always be aware of what your employer, if any, is putting in, if any, NESG, and your personal contributions. They're all still subject to the 25. One of the other questions we get there is, how about insurance premiums? As insurance premiums tend to go into super as part of the contributions that come straight out, are they included in the 25? The answer is yes, they are. You cannot put in your 25 and then an additional amount for your insurance. It's all part of that 25,000 cap. You must still complete the notice of intent, the 290-170, and receive acknowledgement. As I said, you're going to hear a lot about 290-170, and notice that what we say there is that it must also, what I have been saying is that it needs to be a valid notice of intention, and to be valid, it must be lodged the earlier of putting in either your tax return or 30 June of the next financial year. It must also, the super fund must still also hold that contribution. Therefore, if you withdraw or you roll over, you can have a problem, and you cannot have started an income stream. If any of those events occur, then the form is no longer valid, and that puts at risk your ability to claim a tax deduction on that contribution. So our key points here really are that this new rule is very, very useful if there's no access to salary sacrifice arrangements. It's very useful if you're primarily self-employed and coupled with an employment arrangement, aka our doctor. He can now claim those superannuation contributions up to 25,000, and it's useful to top up super from unexpected cash resources, e.g. from bonuses or inheritances or things like that. And it's worth reiterating that this is open to all employees. So somebody who is a full-time employee, for example, and is receiving, say, $9,000 in SG contributions and is putting in another $1,000 in salary sacrifice to make it around $10,000, even though they're fully employed, they can now make up to an additional $15,000 to take it up to 25 and claim a tax deduction if they have that cash sitting around or if they unexpectedly come into it, as we've said there. So very, very powerful new rule there. Non-concessional contributions, which obviously contributions from after-tax money where no tax deduction has been claimed. So the new rules here from 1 July 2017 is that non-concessional contributions cap will reduce to $100,000 per annum. Previously, it was $180,000 per annum. That's been wound back now to $100,000. All of these caps, of course, are indexed at various rates, but certainly at this particular stage of the game and into the foreseeable future, this is where it's going to be staying, is at the $100,000 per annum. Also new from 1 July 2017, the total super balance must be under 1.6 million in order to make a concessional contribution of any amount. So again, this is where our total super balance is coming into play, not the transfer balance cap, the total super balance. So somebody in the government has made this rather arbitrary decision that if you've got 1.6 million in super, you shouldn't be allowed to put any more non-concessionals or elective amounts into superannuation because I gather you're probably rich enough. Yeah, I know. But this is the new rule from 1 July, worth reiterating. Your total super balance, that is accumulation funds, transition to retirement, pensions not in retirement phase, any pensions plus any rollovers in transit, if they're in excess of, that comes to 1.6 or more, no further non-concessional contributions. Unchanged is the fact that there is still no tax payable upon contributions to the fund. And that's obviously because you've already paid tax on it. So if you had to pay tax going in, that would be double tax. So fortunately, while they may have reduced the amount, there's still no tax going in. And the earnings are still taxed as normal. So again, that's all good. Unchanged also is that it forms part of your tax-free component when it gets to pension phase and for estate planning purposes, no change on that one. And unchanged is that it's available up until age 75, but you must meet the work test from age 65 onwards in order to be able to contribute and, of course, be under that 1.6 TSB. There's also the new bring forward rules applicable from 1 July 2017 because obviously the bring forward rules are related to your cap. So bring forward is still available, but it's been reduced to $300,000 over 3 years, whereas previously it was 540. So the actual amount that can be contributed depends on, again, your total super balance, and we've got a table on the next page which will explain this a bit further, but essentially you can only contribute that amount that takes you up to the 1.6 million total super balance. So if you've got anything under essentially about 1.4 million in super, you're right to put in your 300,000. But once you get in that period, that spot from 1.4 million over, then there starts to become additional complications and restrictions on how much you can actually get into super under the bring forward. And we'll say have a look at that in the table on the next one. You must have the total super balance of under 1.6 million at 30 June of the previous financial year. If you're under 65, you can be under 65 years of age for 1 day in that financial year, and that will enable you to trigger the bring forward rules. But if you're 65 on 1 July, you will not be able to trigger the bring forward rules. So again, you need to watch your timing on that one. And of course, you must contribute more than the $100,000 in order to trigger the bring forward to give you that advantage. And we would highlight that care is needed if you've triggered your bring forward in previous years, because obviously if you trigger the bring forward in either 2015 or 16, then you'll be working under the old rules. in combination with the new rules, which gives you transitional arrangements, which can get a little bit tricky. If that is in fact the case, do suggest very, very strongly that you seek some professional help or see your accountant or somebody along those lines to get that one sorted. So this table here was put out essentially by the ATO to help people work out how much they can actually bring forward. And as you can see, as I mentioned in the previous slide, if you have less than 1.4 million, then you can contribute up to 300,000 in the next 2 years. And there's a bit of confusion over 2 and 3 years. It's over 3 years, but of course you make the contribution in year 1, you've then got another 2 years in order to complete the bring forward arrangement. So that's 1 year that you're making the contribution, 2 years of bring forward, 1 + 2 = 3. Pretty high powered maths there. Okay, so less than 1.4, 300,000, you've got the following 2 years in order to bring that forward. 1.4 to less than 1.5, 200,000, and you've got only 1 year in order to be able to do that. 1.5 to less than 6 you can only put in 100,000, and therefore there is no bring forward because you can't put in more than 100,000. Therefore, you've never triggered it. And if you're 1.6 million or more, as we said right at the beginning, you cannot make any non-concessional contributions at all. If you're looking at those numbers, yes, you're quite right if you're thinking, wow, $1 can make a big difference, can't it? Because if you look at those numbers, you could have $1.39999 million in super, and you're under 1.4, so you can put 300 in. But if you've got 1.4 million and $1, then you're over the 1.4 million. Therefore, you're down to 200,000. So again, watch your balances very, very carefully because you don't want to go into excess. Spouse contributions. This is where you're making contributions to a spouse account and you're claiming the $540 tax offset. Probably the $540 tax offset is no longer going to be the really key issue here. We think is probably going to become much more important due to the 1.6 million transfer balance cap, not total super balance, transfer balance cap. Obviously, if you're looking at your retirement planning and how much you can get into super, which reflects therefore on how much you can contribute, you want to maximise the amount that you can get into the tax-free earnings area of pensions. And as that is now limited to $1.6 million per person, whereas before it was sort of basically unlimited, if you're going to maximise your amount in tax-free earnings for retirement purposes, you need to make use of both transfer balance caps for yourself and your spouse. Better to have 1.6 fully funded for 3.2 million in tax-free rather than 1.6 in one and only $100,000 or $200,000 in the other. So it's going to become increasingly important to try and get as much money into both spouses' names as possible. And of course, that's going to get more difficult because the bring forward rules have reduced the amount that you can do a recontribution strategy for or give to your spouse to contribute into super to exercise he or she's bring forward rules because it's reduced from 540 down to 300. So you're going to need every weapon in your armory to get as much money into your spouse's accounts in order to maximise the amount that we can get into superannuation. So if you're going to make use of the spouse contributions, again, we have some new rules or new changes from 1 July 2017, and there are changes to the eligibility criteria. So there's a new spouse income threshold, as you can see up there. So to get the full rebate, the spouse income has to be $37,000 or less. That's up from $10,800, so that's quite a jump. Gradually it reduces and phases out when the spouse income reaches $40,000, and that obviously was formerly $13,800. So the ability to make the spouse contributions and gain the tax offset has certainly been widened. There are also other new rules, and we're coming back to our TSBs here, our total super balances, because the contributing spouse is not going to be entitled to a tax offset if the receiving spouse exceeds their non-concessional contributions cap for the financial year, or if the receiving spouse has a total super balance equal to or exceeding 1.6 million. So again, we're butting heads with this total super balance concept. Unchanged are many of the other criteria. I haven't included all of them, but the key ones there are both spouses need to be Australian residents, must not be living separately on a permanent basis, and contributions must not be deductible to the contributing spouse. So if you like, it can only be funded from, it's effectively a non-concessional contribution. Super co-contribution. Subject to certain eligibility criteria, the government may contribute up to $500 to an individual's super fund. This is always a very good 30 June strategy. And okay, it may only be $500, but you may as well get $500 from the government for nothing. And let's face it, if you do it over enough years, then it can start to mount up and be quite a significant amount. So it's always good to go for. So from July 1 July 17, change eligibility criteria. The incomes test threshold has increased in line with the WATI, and we can see what they are there. The lower threshold is gone up to 36,813. Sorry, the lower threshold from up to 36,813, and the higher threshold is $51 and $21 per annum. The individual's TSB must be 1.6 million or less at 30 June of the previous financial year, and the individual must not have contributed more than their non-concessional contributions cap for that financial year. Once again, many of the other criteria remain unchanged, but you do need to be aware of those new ones. Okay, need to keep this one moving along. I've just provided on this slide a bit of a table here, because it can get a little bit complex trying to work out what the super co-contribution is. I think the good news there, though, is that the ATO will actually work it out and simply credit it across once you put in your tax return. But you can see there the 50% rule kicking in. $1,000, you contribute a personal super contribution of $1,000, $500 from the government. There's your 50%, but then it gradually decreases depending on where your income is between those two thresholds. So that's a little bit of a ready reckoner to try and help you out with a few of those things. Okay, contributions and the three common problems. And as I said earlier, these are problems we face every single year. I really cannot emphasize these enough. Year after year, we just keep getting these questions. So the key here really is get it right first time. Timing of the contributions is a perennial problem. When is the contribution received? There's all sorts of different contributions you can make. I'm only going to cover the three main ones here. Cash payment by yourself. It's when the cash is received by the super provider. So really, if you're doing it on the 30th of June, the only way you're going to get that is to physically come into the office of your super provider in Connor Street here and plonk the cash on the desk. Not something we encourage, but it's literally that literal in what you've got to do. Of course, a much more common one is electronic funds transfer by you. Then it's the date the funds are credited to the super provider's account. It is not when you push the button. Again, this is always a big problem when 30 June falls on a weekend, or when people forget that simply because you've pressed the button on the night of the 30th of June, it actually doesn't transfer for a day or so. And if we receive it on the 1st of July or the 2nd of July, you've missed out on that date. So the key issue here is please do not leave it until the last moment. The third one is a cheque sent by you, probably less common these days, going the way of cash, I suspect. But just because you've written out the cheque, signed it, dated it, put it in an envelope and sent it off, not good enough. It's when it's received by the super provider, and so long as it's promptly presented and honoured. So it's no good getting it in on time and then not having the funds in the bank and saying, oh, I didn't know that, I'll just reissue another cheque. No, all of those conditions need to be met. It needs to be received by us, it needs to be presented promptly by us, and it needs to be honoured by yourselves. So three key issues. Please do not leave these things until the last moment. We come back to our notice of intent. Absolutely critical. Must be completed and acknowledged prior to the deduction. If you withdraw, roll over, or begin an income stream, full or partial, prior to making the 290, 170, you will lose or only get a partial deduction. And you cannot roll it back, and it cannot be backdated. As I said earlier, to be valid and it acknowledged, what actually happens is with a partial withdrawal, the ATO's formula assumes that part of the current year's contributions are also withdrawn. So if, for example, you've got $100,000 in super and you put $25,000 in, and then you roll out $50,000, part of that rollout is going to include part of the $25,000 on a proportional basis. So therefore, the super fund no longer holds all of that contribution. Therefore, you cannot get a deduction for the whole amount. A lot of cases that we see here are where people have been contributing to a superannuation fund, retail, self-managed, doesn't matter which, and they get tired of that particular fund and they roll it over to a new fund. Well, guess what? If you haven't put in the 290, 170, that fund no longer holds that contribution. You will not get any deduction at all, and you cannot roll it back. So again, very, very important to get the timing on your 290, 170 right. Again, it's easier in a retail fund because obviously we ask you that question when you make the contribution, and we send our note out to you at the end of the financial year to say, have you put it in? Do you want to put it in? Different story with the self-managed super funds where you've got to do all this yourself. So again, very, very critical. And the other one is super deduction greater than the assessable income. The issue here, of course, is that the excess deduction is lost, but the 15% tax is still deducted. So an extreme case where you've got no income, you put in your $25,000, you claimed a tax deduction on it, or you say you're going to claim a tax deduction on it, so the super provider deducts the 15% tax. They deduct $3,750 worth of tax. The tax office then comes along to you and says, oh, no, you don't get that deduction because you don't have the income. But the 15% tax has still been deducted. So you've got no benefit of a deduction, but you've paid the tax. So in those situations, there are some very, very limited cases where you might be able to vary your 290, 170 down to zero. You can only vary your 290, 170 form downwards. But in order to vary it, it needs to be valid. So again, this whole issue of your 290, 170s and making sure that you get all this right is very, very important. So much, much easier if you can get it right first time. So when you're making your contributions, please try and avoid these three very common problems that we keep coming across. Talk to your accountant, talk to your financial advisor to make sure that you get it right first time. Okay, looking forward, we've got we're just going to be dealing with two of the new contribution strategies that are going to be available. And I think the key with these is that it's very important to start planning forward to make the most of these opportunities. They are not opportunities that you can usually sort of just take advantage of at the last moment. So very important to be aware of them and to start planning, as you'll see. So the key one is a new one is that from 1 July 2018, that's next financial year, individuals will be able to carry forward any unused amount of the concessional contributions cap over a rolling 5-year period. Sounds complex. Essentially what we're saying here is that you've got a $25,000 concessional contributions cap that you can claim. If you only put in 10, you've got 15,000 which is unused of that cap. You can accumulate that excess amount over a 5-year period and then get a tax deduction for that accumulated amount in any one of those years. So this is really put in place to help those with broken work patterns, such as women who obviously spend a lot of time out of the workforce, or can spend a lot of time out of the workforce. It enables them to put in an amount significantly more than the 25,000, but it's useful for others as well. So it applies to people who are receiving contributions from an employer into super, salary sacrifice into super, making personal contributions to their super and claiming a tax deduction for their contributions. Following criteria must be met. It's not all roses. We've got a couple of things that we've got to criteria we've got to meet. The amounts carried forward. That must not have been used for 5 years will expire. So it's a case really of use it or lose it. They only carry forward for 5 years. Then the last one drops off, the new one pops on. The first year in which the unused concessional contribution is available is actually going to be 2019-20. If you think about it, it's an unused cap. It doesn't start until 2018. So you won't know until you get to 30 June 2018 how much you've got unused. So the first time you're going to be able to claim this is in the 19-20 year. You can only able to use or utilise any carry forward unused concessional contributions cap if your total super balance at the end of 30 June of the previous financial years is less than 500,000, not 1.6 this time, just to keep you on your toes. TSB here is 500,000 in this particular case. Very, very powerful tool when it's linked to the increased deductibility of personal contributions. Have a think about this for a moment. Let's suppose somebody's not making any contributions. They're self-employed. They're not making any contributions at all, any concessional contributions to super at all. 5 years they can accumulate it. That's 5 years at 25,000. That's 125,000 plus the 6 year, which they can make the contribution, is $150,000 deduction. How many $150,000 deductions are available these days? So it is possible, if you plan it correctly and if you're in the right financial circumstances, to end up with $150,000 deduction per person. So if you're expecting or planning for a large capital gain, small business CGT, property sale, things like that, planning ahead knowing that you've got this deduction coming up or that you can accumulate this deduction over time can start to become a very powerful strategy. This table here just briefly goes into a quick example of how it actually operates. You can see there 18-19, the person contributed 10,000. They've got available unused cap of 15, cumulative 15. Same happens in the next 3 years. They end up with 45,000. In 2021-22 year, they've got 45,000 accumulated. They've got 25,000 in the next year, which gives them a total of 70. They put in 40. 70 minus 40 still leaves them 30,000 there going forward. And that's just how it works over time. So I'll leave you to have a look at that in your own time. Downsides of contribution, getting quite a lot of questions about this one. And this is also new and is available from 2017-18. If you are 65 or older, you may be able to make a downsizer contribution into super of up to 300,000 from the proceeds of selling your home. The eligibility criteria are 65 or older at the time of the downsizer contributions, and note there is no maximum age limit. So there's no limit of 75 on this. If you're 80 or 90 and you need to get money into super, there is the ability to do this. There is no work test required for this either. So again, very, very powerful tool. You don't have to be working it. There's a 300,000 limit, but it's available to both spouses. So there's actually the possibility of getting a total of 600,000 in. It is only valid if the contract of sale is on or after 1 July 2018, not settlement date after 1 July. So if your client or if you've already sold the house and settlement is after 1 July, sorry, you've missed out. You're too early for that possible opportunity. The actual sale contract has to be after 1 July 2018. The home was owned by a member or, very important word there, or spouse for 10 years or more prior to the sale. So, there's a number of sort of asset protection strategies used to be put in place for people who are in high risk where employment jobs where the house was in the name of the spouse because the working partner didn't want to get sued and have the house able to be accessed by in bankruptcy and things like that. So if that is the case, you can still, both partners are still able to get that 300,000. The home is in Australia and it's not a caravan, houseboat or other motorhome. They've been specifically excluded. It must be wholly or partially eligible for the main residence CGT exemption. Again, important there, wholly or partially. It doesn't have to be the whole thing. So it could have been, for example, an investment property for a period of time and then become your main residence. But it must have been your main residence at some stage because you must be eligible wholly or partially for that main residence CGT exemption. That effectively knocks out investment properties. You're not going to be able to sell an investment property that was never your main residence and try and put the money in under this particular rule. So it's only relevant to your main residence. The max is 300,000, but cannot be more than the total sale proceeds. So don't think that you can sell a unit that you've had and you've been living in the country and sell it for 150,000 and then put 300 in. No, maximum is 300, but it can't be more than the total sale proceeds. Obviously, you've got to advise a super fund using the correct form, and you must not have previously made the downsizer contribution. How does this interact with our non-concessional contributions, our total super balance, and our transfer balance caps? Well, the downsizer is not a non-concessional contribution and therefore will not count towards the contributions caps. That's good news. Timing and order of contributions could be important in some cases, and we'll have a quick look at that one in a moment. This is particularly true where other non-concessional contributions need to be made. It can still be made if the individual has a total super balance greater than 1.6 million, and it will not affect your total super balance until the individual's total super balance is recalculated to include all contributions, including the downsizer, on 30 June at the end of the financial year. So you've got a period, if you put it in sort of on 1 July, you've actually got a full 12-month period there where it does not count in your total super balance. And of course, you remember your total super balance is critical in looking at what other contributions you can put into super. But after that 12-month period, it gets caught in your total super balance, and that's where the order in which you do these things can become important. As for the transfer balance cap, we've already said it has nothing to do with contributions, but of course, once the downsizer is in super, if you then start an income stream with it, then you've moved that into retirement phase, and then that will count towards the transfer balance cap. So in an extreme case, you've already got your 1.6 million in pension, so you're already at your transfer balance cap. You can still put in your 300,000 downsizer because TBC does not affect your ability to make a contribution, but you would not be able to begin an income stream with that because that would then put you into 300,000, an additional 300,000 in retirement phase and in excess of your 1.6. Simple, eh? So timing can get very, very important here. For example, let's suppose you've got 1.5 million in super and you sell your home and you've still got 100,000 in cash that you want to get as a non-concessional contribution into super. If you're putting your downsizer first, then it takes your TSB up to 1.8 million, and therefore you cannot get any further non-concessional contributions in. But if you reverse that order, start off with 1.5, you put in your 100,000 non-concessional, that takes you up to 1.6, that's fine. You can then put in your 300 because it's not a non-concessional contribution and doesn't count towards your caps, and it doesn't matter if your total super balance is over 1.6. So that way you can, by getting the timing right, you could actually get additional non-concessional contributions into super. So again, forewarned is forearmed. Just watch your timing on those issues. We are getting towards the end. Self-managed super funds. This particular one really is in the done and dusted category, but if it's not, you do have about 2 weeks left to do something about. So I thought it was just worth mentioning it because what the ATO has actually done is it has extended the date for lodgement, which was usually around about the 22nd of May of the following financial year. It's actually extended to 30 June. So they've given people additional time to get their annual returns in. So this relates to your transfer balance cap and the $1.6 million cap that we have there. And typically people may have had, say, 2 million in super, and as at 30 June, as at 1 July, they had to make sure they only had 1.6 million in pension, and the other 400,000 could be in accumulation or taken out, etc., etc. You can read all that there. As I say, it's not to do with contributions, and it is a very complex area, so I don't want to get too far into it. But the real issue here is that the CGT relief is provided by a deemed sale of the asset, which resets the cost base and provides the CGT relief. And then there is a deemed repurchase, which provides the new CGT cost base going forward for any future sales. They're all deemed. You don't actually do them. They are deemed. You must elect to take that CGT relief, in other words, to reset that cost base. And then there is a second election which allows you to postpone the actual payment of that CGT liability to a future date. So I'm not going into it any more than that, other than to say there are two elections which can be made. They don't have to be made. You don't have to do anything, but if you want to do them, then you need to make those elections, and those elections have to be done by the date you put your annual return in. So if you haven't done it yet, you've got until 30 June when the annual return goes in. So make sure you've got that under control, that you're talking to your accountant about that particular one. Of more interest or more confusion is probably the new events-based reporting, or otherwise known as TBAR, the transfer balance account reporting. And essentially for self-managed super funds, what most people are sort of saying is that they actually don't have any obligations to report, or they don't start until 1 July 2018. Not strictly true. As you can see from the slide here, from 1/7/2018, new reporting obligations for the TBC are being brought in, and essentially it's to allow the ATO to track and record the transfer balance, cap and total super balances for all these things we've been talking about. So generally people are saying there's no need for super funds to start TBAR until 1/7/18, but you do need to document all income stream valuations and decisions in the 17/18 year. That is up to 30 June of this financial year for reporting after 1 July 2018. So it's going to be looking backwards. And the ATO has already come out and said, look, there's not going to be any special circumstances or discretion for contraventions of the TBC. You're a self-managed super fund. You need to be aware of these and to self-monitor. So again, read the rules, and it comes down to here when to report. So pensions in retirement phase. So that means if you've got account-based pensions going, for example, that are being received at 30 June 2017, that's beginning of this financial year, they need to be reported on or before 1/7/2018. Yet we've just said there are no obligations before 1 July. This is where I say, it's not all that it seems, and you do need to be aware of this. You need to be talking to your accountant about some of these issues. From 1 July 2018, generally all member balances less than $1 million need to be reported at basically the time that you do your annual return. Any member with balances 1 million or greater than 28 days after the end of the quarter in which the event occurs. So this is a timing issue. And while we're talking timing issues, be aware that there is a big trap here, because if you're in a retail super fund, we have to report much more quickly. So if you've got a self-managed super fund and you decide for whatever reason that you're going to roll a benefit to a retail fund, you don't report that. You don't have to report that until the end of the quarter, until the end of the year. When you do, the ATO will take note of that under TBAR and will provide a debit to your transfer balance account to reflect the fact that it's left your super fund. The problem is you've credited to a retail fund. They report basically straight away. So what you're going to find is that the retail fund has reported a credit to your account, but the self-managed super fund hasn't reported the debit to the ATO. And therefore the ATO is simply showing your existing balance in your self-managed super fund plus the rollover credit to the retail fund, and it's going to put you in an excess in their eyes, even though it's not in fact. So again, timing issues are becoming very, very important here. Pretty much the last slide, I think. What under this TBAR, what do we need to report? Well, you need to report pensions that are being received as at 36/17 that will continue to be paid and are in retirement phase. New retirement phase pensions and death benefits, reversionary or otherwise, and any commutations. Some limited recourse borrowing arrangements, and the government's sort of still looking at many of those things. Personal injury and structured settlements. You do not need to report pension payments, investment earnings or losses, pension cessations due to assets exhausted, or the death of a member. So again, these are issues that you really need to be talking to your accountant about, to be all over them. But it often means that you need to at least have a working knowledge of them, so you know what the hell's going on. In summary, our key points are that there are many new rules and changes to the old rules, particularly around contributions caps. They are complex and extensive, and it's wise to seek help from a qualified financial professional. Avoid the 3 common mistakes. Timing, don't leave it until the last moment. Notice of intent, make sure you get it lodged and acknowledged prior to rollover, starting a pension or withdrawing. Do not claim an amount higher than the assessable income, because that just makes life really difficult. Carry forward of unused concessional contributions is going to be a really important strategy going forward. Your downsizer contributions are coming up, and watch out for your T-bar reporting. And that, I believe, is just about me done and dusted. I'm not sure how I went on timing, but I'll hand you back over to Liam now. Thanks for listening, guys.
Well, thank you, Nigel. Really good presentation there, and thank you, listeners, for attending today. I hope you found this session valuable and feel more prepared to tackle June 30 and maximise your super savings, really. As mentioned at the very start, we can't answer any audience questions today due to personal advice risks, but if you do have any pressing questions as a result from Nigel's webinar today, I encourage you to email our client relations consultant, Callum Keats, whose details are on the screen. Again, thank you for joining us today. Good luck with your super contributions, and we look forward to seeing you at our next portfolio construction webinar in a month's time. Have a great day. Thank you.